Dear learners, today we are going to see about trading animals in stock exchange. While reading your morning newspaper or watching a TV show on stock markets are like jungles and investors are often compared with animals. Terms like bulls and bears are commonplace. Other than bulls and bears, there are other terms that are used less frequently but would remind you of animal instincts in man. Let's see one by one. First one is the bull. The bulls represent the investors or traders who are optimistic about the future prospect of the share market. They believe that the market will continue its upward trend. Bulls are the ones who drive the share price of a company higher. Bear. Bears are the investors or traders who are totally opposite of the bulls. Bears are pessimistic about the future aspects of the share market and believe that the market is going to be in red. Stacks. These investors or traders are not interested in a bull or bear market. They invest only in initial public offerings. Stacks put money in IPOs to make quick bucks. This kind of investors or traders are not interested in bull or bear market. They just look out for the opportunities. Bulls are the powerful investors or traders who use unethical means to make money from the share market. Mostly, these bulls are involved behind the scams that move the share market when it comes to light. Chicken refers to those investors who are risk averse by nature. They are fearful of the stock market and mostly stick to safer financial instruments such as fixed deposits, corporate deposits and bank FDs. Pigs. Bulls makes money, bears makes money, but the pigs get slaughtered. Goes an old saying. Pigs are the opposite of chickens. They are the risk takers. These investors are always in a hurry and invest mostly on the basis of tips and news. These investors are traders, are impatient, willing to take high risk, greedy and emotional. Pigs are the biggest losers in the stock market. Hawks and doves are terms used to describe different types of policy makers. The terms suggest sensitivity of a policymaker is towards an economic situation. A hawk wants a tough stance in an economic situation, whereas a dove wants to be easy with it. Ostrich. Are you a victim of the ostrich effect? The term ostrich refers to those investors who tend to ignore negative news that can impact their investments. Ostrich are those kind of investors who bury their heads in the sand during bad markets, hoping that their portfolio won't get severely affected. These kinds of investors ignore negative news with an expectation that they will eventually go away and will not impact their investments. Ostrich investors believe that if they do not know how their portfolio is doing, it might somehow survive and come out alright. Sheep are those kinds of investors stick to one investing style and do not change according to the market conditions. They are usually the last ones to enter an upward trend and the last one to get out a downtrend. The sheep like to be on the side of the majority and follow guru. They are not interested on their own investing or trading. Lame duck. A lame duck is a type of trader or investor who trades and ends up with a huge loss. Lame duck have either defaulted on their debts or gone bankrupt due to the inability to cover trading losses. The phrase can be traced to the early years of commodity trading and the development of the London Stock Exchange. Whale. These are the big investors who can move the stock price when they buy or sell in the market. You can make a lot of money if you trade alongside the right whale. Dogs are those stocks which have been beaten down by the market due to their poor performance. Many financial analysts look into the dog stocks closely as they expect these stocks to recover in upcoming days. Dear learners, learning these terms can help you gain some insight into the world of stock market. If you like my presentation, Kindly like, share and subscribe BBA Classroom. Thank you for watching.